Let's stay on the markets here and talk a bit more about everything that's going on in the wake of that news from the weekend that we are set to see the House pass the $1.9 trillion stimulus package later this week, likely signed into law by the president. Joining us now to discuss, Emily Roland, co-chief investment strategist over at John Hancock Investment Management. So, Emily, I guess let's start with, is this new information? We've talked a lot about the stimulus, the impact it would have. The market has front-run a tremendous amount of this. But as we sit here today with this likely now becoming a reality, is this new for the market, and how might investors react?
Well, first of all, thank you for having me. That is an incredible lineup of women that you have on the show today. So I'm thrilled to be part of it. But in terms of the stimulus and the impact on markets, the S&P 500 is up about 71% since the March 23rd low of last year. And certainly that reflects this incredible amount of fiscal stimulus in the pipeline, a very accommodative Federal Reserve and frankly, central banks globally. So some of that's priced in. The $1.9 trillion, I think, is more than a lot of us expected to get. So that's providing an additional kicker here. But it doesn't mean that economic growth is not going to be great in the first half of 2021. And we think it will be. When you look at GDP forecasts, when you look at this acceleration that we're already starting to see in terms of getting back to normal, that's going to be really important. But as far as it relates to markets, there are elements of a portfolio that you want to have in terms of having sensitivity to this. So looking at areas like value stocks in the US, going down in market cap, really embracing things like US industrial stocks that we think can benefit from the fiscal taps really flowing here in 2021. That's very important. We also want to recognize that we want to have some balance in the portfolio. So there is probably a limit to how much growth can get priced in, particularly as it relates to the Treasury yield curve and the yield on the 10-year Treasury, broadly speaking. And once we start to see the momentum shift there, and there's still some time, that's when you want to think about kind of rotating back into those longer duration assets. So for now, we want exposure to cyclicality to benefit from all this explosive economic growth, but we also don't want to get too comfortable kind of fully rotating into cyclicality here. We still want to have some growth and some quality in the portfolio.
Emily, it's Julie here. It's great to see you. Where does the bond market sit in all of this? Because if you can make that argument that, yes, we've seen this huge rally in stocks that prices in some of this outlook for at least some kind of package, maybe it wasn't 1.9 trillion, but some kind of package, you could argue the bond market hasn't really priced that in the same way in terms of the growth, perhaps, the potential growth in the U.S. economy. So if it hasn't, where should bond yields be? And then, of course, what does that feedback loop mean for stocks?
Yeah, I mean, bond yields have backed up really fast here. And we were about 50 basis points last August. And now, of course, the 10-year Treasury is approaching 1.6%. So it's been painful for bond investors. We had lowered the duration profile of our fixed income allocation at John Hancock in order to kind of prepare for this environment and recognize the fact that return expectations in the high quality part of the bond market really need to be a bit more realistic and quite frankly lower over the next year or so. And that's the reason that we've embraced investment grade corporate bonds as the core of our portfolio. So having the ability to generate a yield above inflation and still manage risk is something that you'll get by owning that part of the market. We've also looked at high yield bonds, and in particular, the higher quality tranches of that high yield bond market, the double B space, those fallen angels that have the ability to be upgraded to investment grade corporate bonds. We think it's appropriate to take some very thoughtful risk in the high yield bond market. So getting an allocation to credit without going over our skis and taking risks, still owning some bonds that act like bonds. We still think that you want that as far as diversification in a portfolio, but recognizing that the return potential in fixed income, broadly speaking, is probably not quite as great as it's been over the last couple of years.
Emily, as part of the stimulus plan, some households, eligible households, will be getting a large sum of money. Do you think that will be a big driver of stock prices this year?
Well, so far, all those the stimulus checks have been saved. So we've seen the savings rate in the U.S. increase to levels that we haven't seen in decades, frankly, and it remains to be seen whether that money is going to be spent. I think one thing that's actually interesting to look at is that retail sales are already back to pre-pandemic levels. So the mix of things that people have bought has just changed. So, folks are buying durable things, they're buying household goods. They haven't obviously bought experiences and travel and hotels. So it remains to be seen whether that part of the economy is going to perk up. I think it probably will. But is it going to, explode to levels that I think many in the market are expecting? That remains to be seen. We've never had a post-pandemic economy before. We're sort of writing the history books as we go here. But certainly, I do think that stimulus checks should be supportive of consumer spending here. We're just going to need to see to the extent that people shift that mix of the things that they're spending money on.
All right, Emily Roland with John Hancock Investment Management. Emily, always great to get your thoughts. I know we will talk soon. Thanks for jumping on this morning.